for a deeper dive on what's next for Jerome Powell and the Fed and the market. Let's welcome in David Sekera, Morningstar Chief U.S. Market Strategist. David, it is good to have you on the show. Interested, David, just start a high level where you think we are with this market, David. You know, we did see that sell-off yesterday. There were plenty of folks, David, strategists, technicians who were saying, given the rally we've seen, David, not to say they're bearish on the market, but they have been looking for kind of a near-term pullback here. Is that what you see, David, in kind of near to intermediate term here?
That is what I see, that this was just a short-term pullback, based on the CPI data that came out yesterday. And in fact, when you look at that CPI data, our U.S. economics team specifically came out and told people, not to panic, when that headline, hit the screen. But generally, I would say, the broad U.S. equity market is trading just slightly above, our fair value estimate right now. We are expecting a slowing rate of economic growth, so I do think that's going to weigh on earnings growth over the next couple of quarters. But then we also expect, interest rates to subside over the remainder of the year. So between, those two expectations, market pretty fairly valued, but I do think there's a lot of ways that you can position your portfolios today to be able to take advantage of, some of those areas that do remain undervalued, and then steer clear, some of those areas that are just, significantly overvalued today.
So, David, what are some of the areas in the market that you believe are undervalued right now?
A couple of different sectors that we like. Real estate is one. Of course, it's certainly been under a lot of pressure, last year and this year as well. We just see a lot of areas there that have gotten pushed down, too much. And so when we think about interest rates, coming down, according to our forecast over the course of this year, I think that's going to give a pretty good tailwind for real estate. So one stock there our team really likes is Realty Income, ticker O, trades at a 32% discount to our fair value, has a 6% dividend yield right now. It's a 5-star rated stock. And this is one that, according to our team, has actually the most sensitivity to interest rates. So as interest rates come down, that would be one certainly to watch. And then for people that might be looking for more defensive picks, in the real estate area, I'd call it Health Peak. It's again, medical offices and other healthcare facilities. Another 5-star rated stock, trades at almost half of our fair value estimate, pays a 7.2% dividend yield. Some other areas I'd look at would be basic materials and utilities.
And David, just come back to real estate for a second. I want to get your thoughts on the commercial real estate sector, and certainly, Dave, NYCB, New York Community Bank Corp making headlines for all the wrong reasons there. Any concern you have, David, that that sector, the problems are going to kind of impact the broader banking system, the broader economy, or do you think, and this does seem to be consensus right now to some degree, that NYCB's problems were its own, idiosyncratic?
Yeah, now we don't cover New York Community Bank, but I know our team did take a quick look at it just to see whether or not there were implications for the rest of our U.S. bank coverage, specifically the regionals. And we do think it was really idiosyncratic to New York Community Bank based on the type of real estate and where that real estate was located that they were financing, and just how much real estate exposure they had as compared to their capital. So when we look at the U.S. regional banks, we still see a lot of value there for investors today. Of course, a lot of those stocks did get hit, pretty hard earlier this month. Our go-to stock there has been U.S. Bank. That's one we've been highlighting for a while. It's a 4-star rated stock, trades at a 23% discount to fair value, and pays almost a 5% dividend yield.
And David, taking a step back here, going back to that hotter than expected CPI print, there's been more chatter when it comes to a no landing scenario for the economy. So essentially, the economy would continue to grow, but we would not reach the Fed's 2% inflation target. How likely do you think that is, and what sectors would be most exposed if that were to occur?
Yeah, so the CPI print we don't think was nearly as bad as the headlines suggested. So when our U.S. economics team really got into it and started looking at the difference between some of the weightings and some of the methodologies in CPI versus PCE, we still continue to believe that PCE this year is going to average 1.9% and actually will even subside even further going into 2025. So we're not concerned about inflation. Our U.S. economics team actually is still looking for that first rate cut here in May. So I know that's a little out of consensus right now, but when you think about, kind of the economy slowing over the next couple of quarters, thinking about, interest rates coming down, inflation slowing, I think that gives the Fed the room that it's going to need in order to start cutting rates. The other thing too is, while the Fed is very focused on inflation right now, they still have to keep in the back of their mind, they don't want to keep rates, too high for too long and accidentally cause a recession, certainly potentially in the second half of this year.
And David, I'll get you out here on this question about earnings season. You know, we've heard from the big banks, we heard from big tech, David. Still got some big ones in the pipeline. We've got Cisco today after the bell. What have been your big takeaways from this earnings season, Dave? What have you learned? And what, by the way, do you expect for corporate profit growth in the quarters ahead?
Yeah, so I think things are actually shaping up pretty well for the beginning of this year. You know, the economy, did hold up much better in the second half of last year. It looks like it's actually holding up pretty well in the first quarter this year. I think the biggest takeaway from earnings for me is, my biggest concern coming into it was that management teams might use this as an opportunity to try and lower the bar for guidance this year, just so that it'd be easier to outperform over the course of the year in kind of an environment where we expect a slowing economic rate of growth. And we didn't see that. And I think that's also a big reason, too, why we have seen the market do as well as it has this earnings season.